Welcome all of you. We are Trinity Finvest, a wealth management firm. We bank on your trust. This is our logo, which truly speaks about the value that we stand for. And today we have organized the session, which is referred aptly as Prescription for Wealth, Tax Smart Investment Strategies for Doctors. And it is exclusively for ANIIMS doctors. And I'm hoping that this will be very beneficial for all of you who are very curious to understand what are the tax implications and how you can, accelerate your wealth by saving tax. So all the tax efficient investment strategies will be discussed and in detail, in depth today. And today we have two eminent panelists, our CEO, Mr. GB George, CEO and founder of Trinity Finvest, joining us today. He was ex-zonal head of ICICI Bank with over 25 years of banking experience. And we have also Mr. Ebin M. Behanan, chartered accountant, and he has a long-term over 9 years of exotic practice with the corporate chartered accounting, and he will also give his valuable insight. So welcome both of you to this webinar. And coming to the topics for today's sessions, introduction to financial planning for doctors, which is very relevant. The best in terms and concerns concerning to the FPs of doctors, change in the FPs financial planning, change in the investment strategies when it comes to the new India. What are the new changes and how do we adapt and take advantage of that? And tax efficiency of investment decisions. This is very critical when you want to create wealth, because it's important to know what are the tax efficient investment methods. And also you need to beware of scams and frauds around us, which can result in financial losses. Also, the how to manage tax, the tax management of professional income, especially doctors like you, will be discussed at length with by Mr. Abin and M. Behanan, and he will be taking you through that. So these are the topics covered for this session. So I would like to now invite Mr. J.B. George, our CEO and founder, to start the session. And over to you, sir.
Yeah, thank you, Soumya. Hope I'm audible to you.
Yes, sir, you are.
So, thank you, doctors, for joining today, and that too after a day's session of treating patients, different kind of problems. I can understand that the kind of pressure which you go through day in and day out, and thank you for joining that too on a working day. We will the next 20 minutes, 10 minutes maybe I would take just to take you through what kind of an investment scenarios are changing, how people are changing their habits of investments, etc. And I'll cover some of the contemporary issues like the fraud related to this, and where are we talking about the tax efficiency of investment and so on and so forth. And once that session is over, Mr. Ebin will take you through specific tax saving, tax filing methods, wherein which you will be able to have a better efficiency at your end for every rupee which is managed by you or saved by you. So coming to the point of key attributes of medical professionals, this is what our understanding about the medical professionals, that they are learned ones. They would have put a lot of years in terms of learning, different technically about medicine, and also in that process, you have a better world view and have better access to quality of life. And we generally see at financial field that doctors are the community who can earn up to death, up to they live, because more aged doctor is, more experienced doctor is, the higher the income earning possibilities are, because of their expertise and exposure to best in class people. Because you come across, I'm sure, in or in the Andaman Institute of Medical Science also, you would have come across professionals from different states with investment in equities, with investment in markets, with investment in AIF, and could be a better tax efficient person, and so on and so forth. So your ability to connect with a lot of professionals and to earn a proper diversified wealth creation is possible. And largely invested in asset classes. This is what traditionally what we've seen in most of the places, because of various factors. Doctors look at traditional asset classes as part of their investment, like gold or real estate, etc., or bank deposits, and of course trustworthiness. I've been a banker, as Soumya was mentioning in the intro. Bankers always give low rate of interest to the doctor community, knowing that they can trust them 100%. So your ability to, you are trustworthy, thereby your ability to earn a better interest or a low interest is always there. No retirement age, which I mentioned already, and open to new ideas. Now, yeah. But what can be some of the risk or concerns associated with the doctors when it comes to personal financial management? So one, of course, is high risk takers, right? So because of maybe that market expertise, because of the income formation which is happening seamlessly, probably you're willing to take more risk and thereby susceptible to thereby susceptible to advices around you. So I can see a lot of advisors coming in, and every doctor will have one or two advisor who sometimes can take you to the right path. Sometimes it can put to a lot of issues as well. And lack of time in financial planning, at least in mainland, what we've seen is doctors are busy. Even there are incidents where we conducted meeting at 8 o'clock, 8:30, 9 o'clock, even IMA meetings, and there will be still after the final confirmation, even at 6 o'clock, when there's an emergency case comes, doctor might have to attend that rather than coming for the financial management session. So always keeps you busy, always you move in that direction. Have a high trust on everyone but no verifying. So this is very interesting. When we were taking session in one of the hospital for the senior doctors, one of the doctor was saying that one observation we commonly had, that they had a high life insurance policies. So one of the observation which one of the doctor mentioned is that even patients after getting treated well, after cured, they will come back saying that, sir, my son has got a job in so and so company, so can you take a policy because it is for now his earning. So we were very quite surprised, and the doctor saying sometimes you are too emotionally bound with them, connected with them, that you can't even avoid a policy sourcing by a patient who has been treated well by the doctor. Risk protection. When it comes to personal risk protection, generally we observed that doctors have low personal risk protection, over reliance on fund flow, because generally most of the doctors believe that the fund flow can be like evergreen, uninterrupted. Partnering to unknown businesses. This is one danger we have seen, at least in the mainland. The doctors gets into joint ventures of this, that, like film field, we generally say they get into everything from chapati making to whatnot. So doctors also, because of the friend circle or the advisor circle, you observe some of them at least getting into unknown territories, which finally end them up into difficulties subsequently. Concentrated asset classes is another thing which we've seen. They are mostly on real estate, mostly on gold, etc. So, when it comes to financial advisor, it is important to choose the right advisor. So, you will have to today look at it. Who is your set of advisor? Is it social media what you follow? Or is it friends and relatives you follow? Or the financial influencers, so called fin influencers, or sales agent and brokers? So, our request to all the doctors, and even for that matter, anybody who's aspired to build a long-term wealth, always look at it. Qualified institutional advisors like bankers, chartered accountants, financial planners, or financial advisors, or good wealth partners who can give you regular update, who can give you customized advice, because each of your advice has to be different. There can't be one size fit for all. It has to be customized for you, and it has to have a comprehensive long term planning. It should have cost effectiveness, tax efficiency, And we should also make your advisor responsible for the advice taken from him or the kind of guidance taken from him. Otherwise, nobody's skin is in the game, and finally, everybody can be an advisor, but very hardly select few can only give you result. So, wealth creation strategies for new India is changing from what it was earlier. So, India, as you all know, that still continue to hold the top GDP growing country in the world, as compared to say emerging markets, as compared to US, UK, European Union, etc. Compared to China, we are still hold the highest growing GDP oriented nation, or the country with the highest GDP growth is still there with India. So IMF projection is 6.8, this year projection is 6.4. So it has been a continuously good journey for us, and thereby people at large, not only doctors, but people at large, moving away from the traditional way of investment in gold, in chit funds, in fixed deposit, in real estate. All this one was maybe a 10-year back or 15 years back or 5-year back. This would have continued to be an asset class of investment largely with people. But now it is changing towards various investment class, from direct stock to mutual fund to advised portfolios, PMS, and alternative investment. Today, Indians are, by growth of the country, by growth of the financial system, having some excellent regulators with us, we have also increased, diversified the options of investment from traditional asset classes to modern asset classes, like stock picking has become very very important strategy in their wealth creation. Mutual fund, where from equity, debt, and hybrids, there are so much of options available for customers to manage funds and a different mutual fund. And if somebody who want to take a higher risk and higher return, maybe stock portfolios, advised stock portfolios, which we call it as IAP, is another good option. And portfolio management services, PMS is generally known as, with a 50 lakh kind of a minimum investment amount. PMS has become very very important asset class in our people's mind as part of wealth creation. Alternative investment, which is 1 crore plus investment bucket, and that has become another big asset class today. Even in Kerala, where we operate out of, every month we are able to now pick up large amount of 1 crore plus investment in AIFs, and even rural areas are now familiar with the alternative investment fund too. So one need not have to depend on real estate, need not have to depend on gold to create wealth in today's world. People are willing to look at it, better investment avenues with a high risk and higher return possibilities. So the world is changing, thereby India is also changing. So, like this in SIP examples, what we show, this is just an example. So, allow us that freedom. Now, a doctor, he was putting a 5,000 rupees a month, or anybody for that matter, for a 30 years, even conservatively, if the fund is able to generate a 12% return, that fund can create a corpus of 4.5 crore with just a 10% increase on every year. So again, I'll repeat, a 5,000 rupees for 30 years of investment with a 12% return with an annual increment of 10% each onto that amount can create possibly very, very conservatively kind of a 4.5 crore kind of a figure. So imagine that if the funds have been good enough, and if that is able to deliver a 15%, imagine that if that is able to generate an 18% return, which has happened in the past. But when a long term, when you take a 20, 30 years, possibly a 12, 13 percentage could be the best possible return one can expect from a equity market. And still that kind of a discipline. What I meant here is a discipline of this kind can create a long term wealth for each of us and each of the doctors. Now, when it comes to mutual fund, generally people feel that, oh, it's all high risk and I may not fit into. I wanted to tell you that even for one day, there are funds which can cater to your need for one day, 1 week, with a average return of 5%, 6%, while it is subject to market risk, of course, but still it can give you that kind of a option under mutual fund without a single rupee equity exposure, without a single rupee stock exposure. And there are funds like ultra short term fund, arbitrage fund, and then when you are looking for a longer horizon, a 6 months to 24 months, maybe corporate bond fund, hybrid conservative equity funds, which can give a double digit return. And you look for maybe a larger period like a 3 year, 2 year to 3 year, maybe we should look for balance advantage, multi asset fund, asset allocator fund, or equity funds, which can possibly give you much higher return than this double digit beginning return, and have a better, risk and return reward ratio. So there are mutual fund which almost have a nil risk, right? Under overnight and liquid funds, which only invest into government securities, and to full equity funds, which can give a higher return with a moderate and high risk. So there are so many investment strategies available for you to make wealth in the long run. And people are moving from pure bank deposit, which gives you 5.5 to 8%, with a tax rate of 30%. People are moving into NCDs with a higher return and same tax rate, or moving to structured investment with a higher return and a low tax rate. So there are different investment vehicles. Even a customer is looking for a fixed income, or a doctor is looking for a fixed income, moving away from uh, high return fixed income to high return structured product. From typical real estate customer holding physical assets, people are and then earning a 3 to 5% return every year, now moving into real estate investment funds, which can possibly generate 10 to 15% return without having a physical holding, but having a digital holding of your real estate piece. And these funds invest into commercial real estate in top five, top six major cities like Bombay, Delhi, Ahmedabad, Hyderabad, Pune, etc., and able to generate a better commercial return on investment without having the hassles of holding a property and maintaining a property. My objective today is not to sell it or to give you a product or sell a product, but to give you a perspective on how tax can be efficient, tax efficiency can bring into your investments when it comes to from a fixed deposit to gold, PPF, bonds and debentures, and to equity. There are 8 or 9 investment classes available today in India. All are regulated by either SEBI or PFRDA or RBI or IRDA, which can give a different kind of return, and also can be more tax efficient. From 30% tax bracket, it can come to 12.5% tax bracket. So there are funds. What is earning, giving you the 30% tax liability, which are those interest income like a bank FD, mutual fund, debt fund, rental income, F&O trading income, etc. This is what always make you pay the 30% tax. But what type of investment do you have which is zero taxable? Maybe agriculture income is the first and foremost one. Public provident fund, gratuity fund, insurance claims, etc., still hold around 0% tax. When it comes to capital gain of your investment, how your return on investment can be more tax efficient when you are putting into mutual fund, when you are putting into portfolio management, AIF, etc., where tax liability comes down to 12.5%. Where is your capital tax can be 20% when you are looking at equity short term or a gold investment, etc. So based on each of your risk appetite, the return can be better and the tax can come down. That is the beauty of tax efficient investment planning. Move on to decades of delay. When we look at it at 20s, we think that it's too early. When we are at 30s, we think it's too busy time settling as our families. When it comes to 40s, we believe that children education, housing, everything takes center stage. When it comes to 50, the sense of urgency of retirement saving starts, or the planning starts, and by 60 we realize that it's too late. So, my humble request to the entire audience today is that if you have not started your financial plan, do start with any one of your choice. Whomever is giving you the trusted advice, start with them. But ensure that if you've not started, today is the day to start, not tomorrow. This tomorrow never comes. And if you've started, always rejig your portfolio once in a while to align with your goals. Both are important. Starting is important, and also realigning your goals, realigning your investment strategies to goals is also important. Let me take this one only to tell you about the frauds. There are so many fake accounts, fake Seroda. You would have seen this video. If you've not, I'm sure Soumya will be able to share it with you. Fake Seroda accounts are created because Seroda is very, very popular app. Same, this Anandarati Financial Services fake apps are getting created, and people have been siphoned off money, that too in lakhs and crores. So be careful about everything comes in your way, offering discounted shares, discounted investments, or a high rate of return, Ponzi schemes, etc. Beware, the money might have gone to non-entity, might not have gone to an entity which you intend to do so. So greed, fear, and free. Stay away from all. There is no place for, there is no free lunch. There is no fear need to be there in the market just because now 16% market is down from October to now, and should not have the fear, and don't expect that somebody else will get you a better earning which is free. So the all three are avoidable qualities one should have. Yeah. So always look at it: risk, return, regulator, redemption, and review whenever you talk about investments, along with tax efficiency. If you don't have tax efficiency, if you don't understand the risk associated with an investment, don't have a regulator associated with it, do not go for such investment that can put you into trouble in the long run. So, finally, to conclude, start financial planning early, right? Diversify your income streams so that it goes from different, you have a professional income, you have an investment income, you have a real estate fund income. So, diversify gold income so that you're able to manage your wealth in a more efficient way. Seek professional advice. Regular financial checkup on your current status is important. So many of us, what we do, we take a life insurance at the age of 25, or we take a mutual fund SIP at the age of 25, and do not review it for years together. At 50 also, you might have an SIP going at 2000 rupees, which is irrelevant. At 50, if your life insurance is just 10 lakh or 50 lakh, it is irrelevant. So ensure that your financial health checkup is done periodically. Allocate time for personal financial management. While your profession demands a lot of time, spend some time with the advisor in managing your personal finance. Budget and track your goals. Be smart on taxes. Avoid shortcuts and be emergency ready. And we, like Soumya said, work with India's best brands as far as trading, portfolio management, insurance, and bank loans and mutual funds is concerned. Every product is curated by a product team before it reaches to you, and we stand with our products, and we stand with our recommendations anytime. So this is what I wanted to, like some we mentioned, we are a AMFI certified, NISM certified, IRDA certified, MSME registered, a proper institution which works on trust, transparency, and ethics as our core. And this is our office. This is our, you can always reach out to Soumya. So let me now invite, with that, let me close this session. Q&A, we will do it together at the end of the session. Let me now, without wasting time, invite Mr. Abin to take the session exclusively on for you on tax management. Over to you, Abin.
Yes, thank you, DP George. You audible?
Yes.
Yes. Once Albert Einstein said the most difficult thing in the world to understand this income tax. I am sure you will disagree uh, on this statement by end of this session. A warm good evening, all the dear doctors. Thank you. I think Mr. GB George explained in detail the objectives of the session today. It is income optimization and tax efficient investments. How income can be optimized? Income can be optimized by reducing tax. It is by way of efficient tax planning. Efficient tax planning is very essential for all individuals. How this income can be increased? That means in-hand income can be increased by reducing tax. How this tax planning can be effectively paved the way for that? If we are doing an efficient tax planning, we can reduce the advanced tax interest. We can select the right tax regime, whether it is new or old. We can select at the right point of time, and we can claim all expenses, all deductions within due date. If we suppose we file the return after due date, all these exemptions and deductions will not be available. So, efficient tax planning is a must for every individual. Next slide. Yes, these are the topics we are going to discuss today. A little bit technical. Heads of income under income tax, source of income for doctors, salary income and taxability, professional income and taxability, applicability of section 44 AD and 44 AD, what all books are to be maintained by doctors, how advance tax to be paid, how the investment income of the doctors will be taxed, and after all, what is the taxation under new regime and chapter 6 deductions. Next slide. Yes, let me start some basics of income tax. Actually, the Indian income tax divides the income of a person into five heads. That is, income from salary is there, income from house property is there, profits and gains from business or profession, income from capital gains, and income from other sources. As you all know, income from salary is the normally in India, the salary of the amount received by resident and senior resident doctors will be classified under income from salary because there is having an employer-employee relationship, so that income will be categorized under income from salary. The resident and senior resident doctors, the receipts they are earning will be from the hospital will be categorized under income from salary. Then the second head is income from house property. The rental income from commercial properties and residential properties will be classified under these heads. And profits and gains from business or profession. The gross receipts, the receipts earned by consultants or senior specialists or specialists from hospitals will be classified under profits and gains from business or profession. In case of residents and senior residents, they are the income received is treated as salary. But in case of consultants and senior specialists and senior consultants, the receipts received is classified under income from profession. Then comes to income from capital gain. That means income from investing in shares and mutual funds. It will be classified under income from capital gains. And income from other sources. It is a residual section. If the income is not classifiable under above four heads, it is classifiable under income from other sources. Example like interest income from fixed deposits and dividend on shares. Next slide. Then why it is important? The categorizing all income into different heads is very important because each head has got different set of rules for computation of income. Salary has got different set of income. I tell you an example. One of my friend who was a resident doctor at that time, he asked me, he has taken a car loan and he's paying interest on that car loan. He asked me whether he can reduce the interest from the salary he earned. I said no. But if he is a consultant, he's working as a consultant in a hospital. Now, if he asked this question now, I said yes, you can claim this interest paid on car loan can be claimed as deduction. And the point is that each heads of income has got different rules for computation. For salary, there is different rule for computation of income. There is, in case of professional income, all expenses which is attributable to that rendering of service, professional service can be claimed as deduction. In case of capital gain, different set of rules. In case of property, you can claim the interest on housing loan. So each category of sources of income, there is different set of rules. Next slide. So basically, the resident, I have told you already, the resident and senior resident doctors, they will be receiving a salary. They will be receiving salary, their salary and perquisites and all. So they can claim this HRA. If they are receiving HRA, you can claim exemptions for HRA. Then they can claim, they can get a standard deduction of 50,000 rupees on their salary, and 50,000 is now 75,000 in new tax regime. And the resident doctors have to file the income tax return annually, reporting their salary income applicable deductions. Next slide. These are the deductions available to resident doctors. A standard deduction is available, that is 50,000 rupees. If all regime is altered, I will give a detail of what is all regime and new regime. Then they can claim the, as we discussed, they can claim the professional tax as deduction. They can claim the HRA. They can claim the exemption for HRA they receive. Then they can deduct the Chapter 6 deductions like tuition fees, PPF, NPS, and life insurance premium. I will just give a brief of how the income will be calculated under income tax. I already told you that there are 5 heads of income. We aggregate the income under each of this head. Then we get that gross total income. From the gross total income, we can reduce the Chapter 60 deductions like deductions for insurance premium paid, deductions for tuition fees of children, PPF contributions, NPF contributions. We can reduce that. Then we will arrive at the total income. And on this total income, we are paying tax at the slab rates. Slab rates is applicable on this total income. This is the basic of income tax. Now we are moving to we have just discussed about how income will be calculated under salary. If you are getting a salary income, what all things can be reduced? We have just seen that. Next slide. Then we will move on to next, income from professional income of a doctor. Professional income of a doctor will be received in 2 ways. One we have already discussed, that is in the form of salary. Next thing is professional income in the nature of business or profession. That is, the consultants, senior consultants, and specialists and senior specialists will be receiving revenue from the hospital. From the hospital they are working. That is one kind of income. Then suppose a senior consultants or consultants having private practice, they are getting income from their private practice, consultations and all. Next slide. Yes. How this professional income will be taxed? We are going to discuss that. The doctor's profession, the medical profession has got separate provisions for calculating income tax. One section is section 44 ADA in income tax. It provides an opportunity, or it provides a simplified tax regime for doctors. Suppose the doctor is earning 50 lakhs as the receipts from the hospital. They can pay tax at the rate of 50%. They can presume their revenue at 50% of their gross receipts. Suppose the doctor is getting 50 lakhs as their revenue, they can simply offer 25 lakhs as their income, and the slab rates will be applied on that income. So that is applicable only in case his income is up to, his gross receipts is up to 50 lakhs. If it is above 50 lakhs, he has to get his books of accounts audited by a chartered accountant. And one more thing to be added, suppose the cash receipts is less than 5% of gross receipts, this 50 lakhs criteria will be increased to 75 lakhs. Suppose the doctor is receiving 50 lakhs from the hospital and he is receiving, suppose, 10 lakhs from his private practice. Out of this 10 lakhs, suppose he is getting uh, 8 lakhs as cash. So total he is receiving 60 lakhs. It is above 50 lakhs and less than 75 lakhs. But his cash receipts is 8 lakhs. 8 lakhs is more than 5% of 60 lakhs. So his books of accounts has to be audited by a chartered accountant and he has to submit the tax audit report also. And the doctors, it is a simplified tax regime. Simplified tax regime for doctors. They can simply calculate, they can simply offer 50% of their gross receipts as income and he can file the return. Very simple process. Suppose if the gross receipts is more than 50 lakhs. Next slide. Suppose if the gross receipts is more than 50 lakhs, then mandatory tax audit is there. He has to maintain books of accounts. He has to maintain the records of revenue, records of expenses, and this records of expenses or revenue is to be audited by a chartered accountant. And the chartered accountant has to submit the tax audit reports. And based on the, he has to submit return based on the actual income and actual expense basis. From his total actual income, he has to he can reduce the actual expenses, and on the balance income, he has to pay tax on slab rates. Next slide. And then, what all expenses can be deductible for a doctor? In case of doctor, in case of consultants or senior consultants, what are expenses they are getting? Suppose they'll be getting income from hospital, they'll be getting income from private practice. Then what all expenses can be claimed as deduction in arriving at their profit? The tax will be paid on that profit. Suppose the doctor is having private practice, they can reduce the staff salary from their income earned. They can reduce the, suppose they are supplying medicines in their private clinic, they can reduce the cost of medicines. Suppose if they are purchasing any equipments, they can claim the depreciation on that equipment. Or if suppose other consumables are purchased, they can reduce the cost of that consumables. Suppose the area the clinic is running in a rented space, they can claim the rental expense as expenditure. They can claim the water expenses and other utility charges. Also, they can claim, they can reduce the expenses they have paid with related to his traveling, hospital visit, and other professional engagements. What all expenses can be, or what all expenses which is attributable to earning that revenue, or earning the professional income can all be, he can claim as expenses while calculating this profit. Next slide. Also, suppose he has taken some car loan on car loan for purchasing car. He can, and if he used the car for the profession, he can claim that interest on vehicle loan. Suppose the space is constructed by himself and interest is loan is taken for that space. He can claim that interest paid for loan also on as expense, including if some professional indemnity insurance is taken, they can claim the insurance premium paid. So all expenses incurred or which is attributable to earning revenue can be deducted. I'll just tell you one actual incident. A advocate was there. His name was Shanti Bhushan. Actually, legal profession is also a notified profession like medical profession, and the procedure for calculating revenue is same as medical profession. This this advocate Shanti Bhushan had undergone a coronary bypass surgery in 1983. What he did know, he claimed that 1.75 lakhs as his expenses. He said that heart is his plant and machinery, and he repaired that. Later on, the assessing officer dismisses his claim. No, no, it is not a planned anniversary. You can cannot claim that, and this is not exclusively incurred for your profession. Later on, he went to the income tax appellate tribunal. Same appellate tribunal also dismissed his claim. Later on, he went to in 2011. He went to the Delhi High Court. Delhi High Court said the same thing. It is not exclusively incurred for your. It is incurred for your profession. It is your expense, but it is a personal expense, not exclusively incurred for your profession. I just wanted to remind you that what all expenses you are incurring, you can check whether it is attributable to your professional income. Suppose you are going for a professional education abroad, you can claim that expenses as your professional against your professional income. So you can have to plan everything in advance how this can be claimed so that we can save a lot of uh, tax. You can track the expenses, and suppose you are subject to audit, you can give the details to chartered accountant for auditing. Next slide. Suppose you are covering under tax audits. Tax audit will be conducted based on your books and reports. So, what all books have to be maintained by a doctor who are having income more than 50 lakhs? Of course, cash book is to be maintained. These are all accounting terms. Cash book means the book having the details of cash receipts and cash payments. Then actual bills has to be maintained for duplicate copies of cash receipts and original copies of payment bills has to be maintained. Then of course daily case register has to be maintained. This register will be having the details of date, patient details, diagnosis, treatment details, and fees charge, etc. So these are to be maintained, which are to be mandated by the income tax department, to be maintained by a doctor who is undergoing a tax audit by a. Then comes to advance tax. If there is a delay in payment of advance tax, due advance tax within due date, we have to pay interest on that. Every doctor who is subject to tax audit, we are not opting for section 44 ADA. That means if he is having more than 50 lakhs gross receipt, has to pay income tax in the 4 installments as detailed in the slide. On or before 15th June, he has to pay, suppose a total estimated tax liability is 10 lakhs. Suppose the doctor's estimated tax liability is 10 lakhs. On or before 15th June, he has to pay 15% of that tax. On or before 15th September, he has to pay 45% of the tax. That means cumulatively he has to pay 45% of tax. And on or before 15th March, he has to pay the tax fully. Suppose his tax total estimated tax liability is 10 lakhs, he has to pay the full amount of tax by 15th of March. If there is a delay or shortfall in payment of advance tax, then you will attract interest under section 234 A and B and C. That means approximately 1% interest per month will be attracted, increasing your tax liability. When doctors having income gross receipts less than 50 lakhs, they have to pay the 100% advance tax. But they are having only but just one installment, they have to pay the 100% advance tax by 15th of March. So far we discussed the major income of doctors. Then we move on to the investment income and its taxation of doctors. First one is shares. Suppose if I invest in shares, we'll be getting capital gain. Capital gain is nothing but sale price minus purchase price of shares we have purchased. If you purchase mutual funds also, same criteria is the sale price minus purchase price is the capital gain. Then fixed deposits will be there. If we earn interest on fixed deposits, it will be taxed under the residual heads, that income from other sources. And as already explained by Mr. GB, that we can invest in alternative investment fund, real estate investment fund, and exchange traded funds. All these are the source of investment income of doctors. We can see how this income generated from this investment will be taxed. Suppose we are getting income from capital gain from shares. There is two types of income: long-term capital gain and short-term capital gain. Suppose I am purchasing a share today and I am selling it within 12 months. It is the gain from that is short-term capital gain. If the holding period is less than 12 months, it is short-term capital gain. If the holding period is more than 12 months, it is long-term capital gain. And how this is taxed? Short-term capital gain is taxed at the rate of 20%, and long-term capital gain is taxed at the rate of 12.5%. Capital gain is sale price minus purchase price, and long-term capital gain is taxed at rate of 12.5% on gain exceeding 1.25 lakhs. If my gain is 1.25 lakhs, I have to pay no tax. So, from the point of view of tax efficiency, this long-term capital gain is more efficient than short-term capital gain. Then moving to uh, next type of income, that is dividend from these shares. Dividend from these shares will be taxed under the normal slab rates. There is no special rates. It is taxable under normal slab rates. Suppose I am taxable under 30% slab rate, it will be taxable under 30% slab rate. Suppose my taxable slab rate is 20%, it will be taxable under 20%. Next slide. Then move on to mutual fund. Same. It is a tax statement is same as uh, capital gain from shares. If the units of mutual fund is holding for more than 12 months, it is long-term capital gain. If it is holding for less than 12 months, short-term capital gain. Tax rate is same as we discussed. That means short-term, long-term capital gain tax tax on long-term capital gain is less compared to short-term capital gain. So effectively, if we move on, suppose say the market is market is stable, and we can just reduce the tax liability by holding the asset, holding the share for or mutual fund for more than 1 year. We can reduce the tax liability. And moving on to debt funds or ETF, that mutual fund debt funds other than equity oriented funds, capital gain is taxable under normal slab rates. And in case of dividend from mutual funds, it will be taxable under normal slab rates. So compared to capital gains, these dividends and debt funds will be highly taxable. Moving to the next slide. Then, as already discussed, alternative investment fund. Alternative investment fund is pooled savings of high net worth individuals. Normally, we have to minimum amount to be invested in alternative investment fund is around 1 CR. There are three categories of investments in alternative investment fund. This fund will be invested in private equities, angel funds, etc. So, from category 1 and category 2 alternative investment fund, the tax rate is same as we discussed. Long-term capital gain will be taxed at rate of 12.5% on income exceeding 1.25 lakhs. And short-term capital gain tax rate is 20%. And interest and dividend, same, will be taxable under normal slab rates. And in case of category 3 investments, category 3 AIF, the income we received from this category 3 alternative investment fund is exempted. That means we have to pay no tax. So comparing the category 1, 2, and 3, category 3 is more efficient, tax efficient. And another type of investment is infrastructure investment fund and real estate investment fund. Same, infrastructure investment fund means it is just like mutual fund, just like AF. The fund will be specifically invested in infrastructure projects. And in case of real estate investment fund, the fund will be specifically invested in infrastructure funds, sorry, real estate assets. So the tax liability is basically long-term capital gain and short-term capital gain. Long-term capital gain taxable 12.5%, short-term it is 20%. Then if suppose we receive interest, rental or dividend, it will be taxable under normal slab rates. And finally, fixed deposit, normal risk-free investment, no risk at all. If you're getting interest income from fixed deposits, it will be taxable under normal slab rates. And for senior citizens, there is a deduction of 50,000 rupees. Now, in this budget, it is increased to 1 lakh under new tax regime. And another income is rental income. Suppose we are having a residential property or commercial property and we are getting revenue from that, it will be taxable under income from house property. We can straight away claim, we can straight away reduce 30% of the income as standard deduction. Suppose we are receiving 10 lakhs as revenue, 3 lakhs can be claimed as standard deduction. Then after that, we can, if suppose we have taken any loan for constructing that, we can reduce the interest we paid on that loan. It is up to 2 lakhs. And suppose we are paying any municipal tax on this property, we can reduce that also. Then coming to slab rates, we have already discussed about slab rates. There are two regimes, old regime and new regime. This old regime is, this new regime is applicable for the current year, that financial year 24-25. So the old regime, we can claim many deductions. We can claim tuition fees. We can claim life insurance premium paid. We can pay it. We can claim provident fund, investment in provident fund deduction. We can claim investment in ULIPs as deductions. All these deductions will be available in the new scheme. And in the, all these deductions will be available in the old scheme. By default, tax is calculated under new scheme. If you want to select the old regime, we have to select for that. Actually, the default scheme is new regime, and if we are having investments, around um, uh, 3 lakhs or 3.75 lakhs, we can this new tax regime will be better. We will discuss in the later slides about the comparison. So this old regime is applicable. This is same as the pre and post budget, and this new tax regime is changed in the budget presented last week. And the new budget revised tax slab for the new tax regime is as follows: for 0 to 4 lakhs nil, 4 to 8 5%, and move on to above 24 lakhs 30%. Move on to next slide. Here we are having a comparison of the new tax regime under the current year and what the finance minister has been proposed in the budget. While reviewing this, we can see that in the new tax regime proposed by the finance minister, if a doctor is earning revenue up to 12 lakhs, if a doctor is earning revenue up to 12 lakhs, he need not have to pay tax. 60,000 will be his rebate. So if a doctor is earning 12 lakhs as his revenue, he has to pay no tax at all. Up to 60,000 rupees, he can claim the benefit as rebate. So we are checking that the proposed tax slab by the tax slab proposed by the finance ministry is more beneficial than the old slab. And comparing the 50 lakhs, suppose you are earning 50 lakhs revenue, suppose the income is 50 lakhs, then as per the present slab, the tax we paid is 11.9 lakhs, 11 lakh 90,000, and the proposed scheme it is 10.8 lakhs, saving a tax liability of 1.1 lakhs. So the proposed slab is more beneficial than the whatever is existing in the which is proposed in the last budget. Next slide. So how this new tax regime can be opted? I already told you that new tax regime is a default one. Suppose if you have to opt for the old regime, we have to, if a doctor have to file a form that is to be submitted before the due date of filing return of income. They can file the form. They can opt for the all regime. All regime. So all regime is advised only when you are having an deduction. You are having a investment of around 4 lakhs. Next slide. Then how this new regime can be opted? New regime can be opted for salary individuals. He can opt in 1 year. Then he can opt out in next year. Then he can opt in third year also. He can alternatively do that. For a professional income, for a consultant or senior consultant specialist, once if he opted out of that new tax regime, it will be remaining applicable for the subsequent years and can be changed only once. He can return to the new tax regime only once. Thereafter, he cannot go back to the old tax regime. Next slide. This is a comparison of old tax regime and proposed new tax regime. You can see that if your income is going up, always the new tax regime is beneficial to you. Suppose in case of income more than 12 lakhs, you can see the green portion. The new tax regime will be beneficial too. By a phased manner, the government is phasing out the old tax regime, that deductions available regime. They are phasing out in a, they are eliminating, or they are removing that old tax regime. Then these are deductions available in case of if in case of you are opting for all tax regime, that is ATC deductions, investments in PPF, EPF, then Suganya Samriddhi life insurance premium paid. Then you can claim the premium paid on health insurance. You can you can claim the, if suppose you have taken, you are paying any interest on electric vehicle purchase, and interest can be claimed as reduction. Suppose you are getting that you are getting income from fixed deposits, you can claim that amount as deduction. Now it is 50,000. Then the proposed budget, it is increased to 1 lakh. Next slide. So these are the basics or background of income tax, and what are the common mistakes which our clients or doctors are doing. They will not be maintaining any proper documents. Suppose when we go for audit at the end of the year, they will not be knowing what all expenses are incurred for some purpose, or they have made payment but they cannot track for what purpose they have made the payment. So for effective tax planning, you have to track your expenses. You can, all expenses which is attributable to revenue can be claimed as deduction. So we have to track and maintain proper records and expenses. Then if they will miss deductions, suppose the return is not filed within due date, you cannot opt for the old regime. Then suppose there is delay in filing of returns or advance tax payments, you have to pay the high amount of interest. That's right. So always plan your tax, always invest in tax efficient investments, always compare the investments, return from investments based on the post tax, after tax. Based on that, you have to compare the investments and make the investments. We can move on to Q&A session. If you have any queries, please ask. I and GB George, Mr. GB George will answer the questions.
Good evening. That was a fantastic and lucid presentation. So I would just like you to know and make us enlighten about the different types of alternate investment funds, type 1, type 2, type 3, which you gave. Thanks.
Okay. Yeah. So basically, category one is more debt oriented, specific funds which has got a fixed income setup. It includes real estate fund. It includes debt fund, and category three typically comes as an equity funds and equity oriented funds. The differences in category one and two is, uh, basically just to tell you that alternative investment is a fourth grade of investment avenue available in the country, starting from stocks, mutual fund, portfolio management, and then the fourth one is alternative investment. So there are different set of investments under category 1 and 2, including venture capital and private equity can come in there in 1 and 2. And category 3 is largely equity listed and unlisted equity oriented funds, and also real estate funds. So category 3, the tax will be paid by the fund in itself. I think category 1 and 2, according to my understanding, the tax liability rests on the
Yes.
customer. Yeah.
Yes.
Thank you, sir. I think type 3 also has the hedge funds.
Yes.
Yeah,
Yes. I believe
it
it
has.
is.
Yes, it
Yes.
has
Oh,
hedge funds
thank
as
you.
well. Yeah.
Thank you.
But this is just to add a point to it. The lot of momentum is getting built on this alternative investment because of the ease of doing. The basic comparison difference is that in P portfolio management, generally the funds have to be the tax liability comes on the investor based on the short term, long term, etc. Here, by law, the fund house have to calculate the tax paid to the government, and to the investor it is paid after netting off the tax.
Thank you, sir.
Yeah, yeah. Thank you, Mr. Evan, for joining. I think this has been always a pleasure to work with you. And thank you, doctors, for joining today. And do convey the sessions feedback with us so that we can improve upon in the subsequent sessions as and when we do. I think we keep doing the sessions for doctors at large. And that is why the presentation itself is created for addressing the concerns and opportunities with doctors alone. Yeah. Thank you very much.
Thank you. Thank you.
Thank you, Jibisa, and thank you, Abin. So we are winding up this session. Thank you all. Have a great weekend, and we'll catch up for the next session. Thank you.